I really want to thank everyone for showing up here. It's my second time in Missoula. One of the many great treats of having this job is it gives me an excuse to visit Montana quite frequently. You're very fortunate to live in a beautiful state with a lot of warm, friendly people. So thanks for yet again for hosting me and entertaining me here. I'm going to kick things off with some basics about the Federal Reserve System and the Federal Open Market Committee. I'll be using the acronym FOMC a lot, and later when we get to the question and answer part of the evening, I'll again be using these letters FOMC a lot, Federal Open Market Committee. And I'll have a few words about my current thinking about monetary policy as well. But the plan is really to spend the bulk of the evening on your questions. One key point that I can't emphasize enough is the views I express this evening are my own and not necessarily those of others in the Federal Reserve System, including my colleagues on the FOMC. So if you're here, you're thinking you're going to hear the perspectives of Chair Janet Yellen, you are not hearing those tonight. Now you're hearing from me. So in terms of basics about the Fed, I like to tell people that the Fed is a uniquely American institution. So what do I mean when I say that? Well, if you look around the world at other central banks, the U.S. central bank, the Federal Reserve, is highly decentralized. So the Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up what we call the Federal Reserve System. So our bank, the Minneapolis Bank, serves as the headquarters for Federal Reserve operations in the 9th of the 12 districts of the Federal Reserve System. So our district, the 9th district, is enormous by area. It includes the state of Montana, North and South Dakota, Minnesota, of course, and then parts of Wisconsin and Michigan as well. So the Federal Open Market Committee, the FOMC, meets 8 times per year to determine the appropriate stance of monetary policy. So I'm not going to get into too many details of what stance of monetary policy means right now. I suspect we'll have a lot of time when we get into questions to talk about that. But the committee meetings, when I talk about the FOMC, how these meetings work is that all 12 of the various regional Federal Reserve, all 12 presidents of the various regional Federal Reserve banks, including myself, and the governors of the Federal Reserve Board contribute to these meetings. We all get together in Washington 8 times per year to deliberate about monetary policy. What's a little confusing is the committee itself that actually votes on monetary policy is a smaller group. It includes only the governors, the president of the Federal Reserve Bank of New York, and then a rotating group of 4 other presidents that changes every year. Now, having representation in this way from around the country really helps the FOMC, I think, mirror the federalist structure of our government. We've got representatives of different parts of the country, the various presidents, that have input into FOMC deliberations. Now, in keeping with this structure, the regional Fed bank presidents typically use the FOMC meetings in part as a way to share local economic intelligence with other meeting participants. Now, we have many sources of such information. But our directors, both in Minneapolis and in our branch office in Helena, play an especially important role in this information gathering process. In mirroring the FOMC schedule that I just described, our boards meet 8 times per year. In preparation for those meetings, board members reach out to a number of contacts to gain an understanding of what's happening now and what might happen in the future in the local economy. They use those interactions as the foundations for briefings that they provide to our staff economists and to policymakers like me. So branch and bank directors thus play a critical role in the making of our national monetary policy. Many of them, as Larry alluded to and mentioned, many of them, along with a few of our alumni directors, are here with us today. And I hope you've had a chance already, but if you haven't, you'll have a chance later to meet and talk with a few of them tonight. What I want to do right now is take this opportunity to thank them both publicly and personally for their valuable and essentially pro bono public service to the Federal Reserve System and the country. And I also thank those of you who are contacts for our directors, because you too are playing a role in providing valuable economic intelligence to us as we make monetary policy. But let me turn back to the FOMC meetings. So these meetings, the committee, consisting, as I said, of 5 presidents and the governors in D.C., determine the appropriate stance of monetary policy. So I'm going to talk a little bit about what this word appropriate means. What does it FOMC, when you think about what appropriate means, you have to know what we're trying to achieve by making monetary policy. So what are we trying to do? Well, the Federal Reserve is a creature of Congress. We're created by Congress through the Federal Reserve Act. And Congress has established what we're supposed to do when we make monetary policy. It specifically charges us with making monetary policy to achieve 2 objectives: promote price stability and to promote maximum employment. And that first goal, price stability, has been translated into keeping inflation close to 2%. Now, what is the FOMC trying to do? What is the FOMC doing in order to meet these objectives? The FOMC has targeted a Fed funds rate, that is a short-term interbank lending rate, near zero for nearly 7 years, since December 2008. Now, there's been a lot of conversation recently about the desirability of initiating a gradual increase in the Fed funds rate sometime in this calendar year. Now, how should we think about whether such a decision is desirable or not? Well, I think the right way to think about this is through the lens of our objectives. Personal consumption expenditure inflation, PCE inflation, has been running well below 2% for more than 3 years. So remember, I said our goal in terms of inflation is to keep inflation at 2%. But now inflation's been running below 2% for over 3 years. It's currently at 0.3%. Now, my current outlook is it will continue. That is, inflation will continue to run below our target for several years. Based on this outlook, raising the Fed funds rate in this calendar year would be inappropriate, because such an action would serve to further delay the return of inflation to our target of 2%. Now, when I've talked through this, I've only used one mandate. I've only talked through from the lens of the price stability mandate. We have another mandate, max employment. And I just think in terms of fulfilling that mandate, I believe the FOMC can best fulfill it by doing what it can to facilitate further labor market improvement. Again, this consideration would argue against raising the Fed funds rate in this calendar year. So under my current economic outlook, the FOMC can best achieve its objectives by keeping the Fed funds rate target at its current level during this calendar year. Now, I want to emphasize to you that this conclusion is actually a fundamentally optimistic one. The data on inflation and employment show that we could produce and consume more as a country by utilizing more of our available human resources. Monetary policy can and should be used to help make that desirable outcome happen. Thank you very much for listening to these opening remarks, but now I look forward to taking your questions.
Thank you, Narayana, again for those remarks. It's truly a privilege, again, to have you in Big Sky Country, and we're all looking forward to what you have to say in your perspective. We're live on a webcast, so welcome to everybody that's watching this on a webcast. We've had questions that have been sent in from this group prior to the conversation this afternoon, or this evening. And so some of those questions will pop up on the screen. We also have a live Twitter feed, and we'll be getting live Twitter questions as we go through, and we'll stop at various times and interrupt the questioning for that. So we'll get started. One of the things that I wanted to explain to Narayana, as well as the people from out of state, is to give them a little bit of perspective on Missoula. And so we're the second largest city in the state, home of the Montana Grizzlies.
This crowd, Larry.
This evening, however, the 8th largest city in Montana is Bobcat Stadium, where they're playing Fort Lewis tonight. And so the Bobcat opener is tonight as well. So if you see people checking their phone during this discussion, they're probably just checking the score of the game more than anything else. So you alluded to it a little bit in your opening remarks. You talked about the dual mandate, and you talked about the difference between monetary policy and fiscal policy. But can you talk a little bit more just about that difference between what you're doing at the Federal Reserve and what the Federal Reserve does with monetary policy compared to what fiscal policy is with Congress?
This is actually a question that gets a lot of attention from economists, and as soon as you say that, there's many different views that you could propound on that. But in general, the Federal Open Market Committee is a group of, as I talked about, is a group of unelected officials. And so appropriately, the range of actions that we can contemplate is very narrow. And typically what we're thinking about is, I think over the past years that I've been on the committee, over the last 6 years or so, we've been thinking about two different kinds of options to pursue our goals. One is in terms of targeting the Fed funds rate, which is the short-term interbank lending rate that banks pay to one another. And the way we can influence that is by changing the interest rate on reserves that banks have deposited with us. So banks have a large amount of deposits with us, reserves, and we can adjust the interest rate on that, and that would then influence the interest rate they would pay to each other for loans, and that would then feed through to the whole economy through all the interest rates you would pay to each other. Now the other policy action we've been doing is to exchange reserves, deposits that we create in exchange for assets that we buy from financial institutions, and that sometimes called large-scale asset purchases or quantitative easing. And this is an attempt to drive down long-term interest rates, because if you buy up long-term assets, you're going to drive up their price, drive down their yields. And this has all been an attempt to, we've had a slow recovery in the last 5 years and 6 years, and this is an attempt to facilitate a faster recovery. By pushing down on interest rates, you stimulate more borrowing, more spending, and that will be good in a time of and we do all this, as I talked about in my statement, to pursue two goals that Congress has laid out. Keeping inflation close to 2%, and also promoting maximum employment. So that's our range of actions. Congress's range of actions, what would be called fiscal policy, is considerably broader. For example, taxes, they're fundamentally in the Constitution, is their ability to levy taxes. And that it's easier to explain what monetary policy is than fiscal policy, because fiscal policy is really broad. So.
In preparing for this week, one of the things that struck me is Monday in the Wall Street Journal. I opened up the Wall Street Journal, and down in the bottom left corner is a picture of you with Stanley Fischer at Jackson Hole. And so that's in the bottom left-hand corner. On the top right-hand corner is a picture of the container ship, which is an industry that we're in, that we talk about frequently at our board of directors meetings. And so it struck me, we had a meeting this morning. We had not only our existing directors, but we had alumni directors as well. There were 20 people around the table from all different aspects of this region. Expand a little bit more on preparing for the monetary policy that you're talking about, the preparation that you do with the input from the people in this room to get ready for that.
Yeah, that's a great question. First of all, when I go to Washington to think about deliberating monetary policy, it's from the point of view of the nation as a whole. It's not, I don't think about how the economy is doing here and think about how we should adjust interest rates so as to fulfill our economic objectives only for the 9th District. It's more, all of us, all of the participants in the meeting, are thinking about how we can fulfill our national objectives. And there are 9 million people in the 9th District out of over 300 million in the country. And so you're not going to make monetary policy only on the economic intelligence here in this region. Having said all that, I think this district has been an important source of information for me about forces in the national economy. And you mentioned what we talked about today, one of the things we've been seeing, we've been a little bit ahead of the nation as a whole in terms of our pace of recovery. Montana's unemployment rate is lower than the nation's. Minnesota's is lower than the nation's. District-wide, we're lower than the nation. But despite that, I would say two things about what we've heard. We haven't heard much in the way of wage pressures building, despite the low rates of unemployment. Today we heard a little bit, I think, about wage accelerations in some high-skilled areas, but sort of a broad-based increase in wage inflation, which you might expect with unemployment rates as low as we've had. We haven't seen that yet. The other piece that I'll emphasize is, despite how good the economy has been in Minnesota and Montana and the rest of the district for a long period of time, outside of the oil boom, which is a very different phenomenon, maybe we can talk about that later, in eastern Montana and western North Dakota, the rest of the district, despite having seemed to have had improved, heard a lot. We continue to hear caution about not making the same mistakes that were made in the 2000s. That's led to, I think, companies being cautious about hiring, cautious about capital expenditures. It slows down the recovery, obviously. It's also made households cautious about spending, and that also slows down the recovery. So I think that one of the things I've heard through all our contacts and is really a sense of what has made the recovery as slow as it has been is this sense of caution, this sense that people are scarred by the events of 2008 and don't want to have that happen again to them.
So we'll have lots of questions coming out of that.
Yeah.
So let's skip and go to the oil boom that you were talking about. And so I thought it was interesting today to talk about, the oil boom was a great example of the description of what monetary policy, what you're trying to do with inflation and the types of things that happen in an area like the oil boom. It's a great example. So
this is a story many of you are familiar with, but in the mid-2000s, were a lot of technological developments in oil extraction that made it possible to extract oil profitably in western North Dakota and eastern Montana. And as a result, there was an enormous burst of economic activity. And we visited I visited western North Dakota and eastern Montana in 2011. We came out there again as a board in the next year. And you're just struck by, boy, this is a boom. You really felt the fact that you hear employers complaining, boy, we can't find workers, wages are really high. You see inflation being generated by how low unemployment is because of the demand for workers. And for example, one example of the inflation we see is that rents in Williston were quoted as being as high as they are in downtown New York City. I thought western North Dakota was really interesting for two reasons. It really showed you what a boom looks like. What we're experiencing right now in the United States is slow, moderate growth, but it's not a boom. And the other thing I think it really drove home is how localized these kinds of economic effects are. This is something we were really struck by. We were keeping track of this in our bank. You see really strong wage pressures in western North Dakota because of the impact of the oil industry. You go even 200 miles away, these wage pressures die off. This is surprising to an economist because you would think that you'd see workers flow in to these high wage areas and that would start to equalize wages. And you actually start to see the wage pressures spill out well beyond 200 miles. It didn't happen. So this was a great learning experience for us about how segmented even the integrated labor market like the U.S., where everyone speaks the same language, can easily migrate, there's no borders, but still very strong localized effects coming from this economic experience.
Okay, one more question, and I'll go to Diane and David for a Twitter question if we have a second. So just to expand on that even more, I think we talked about North Dakota, we talked about the region, and we talk about the data that you're collecting in order to get your perspective that is on behalf of the nation, not just behalf of the district. However, when we talk like we had today, we got an update on the Ukraine, we got an update on things in China. The perspective seems to have broadened. As the world has gotten smaller, the perspective has broadened, and you're not just getting district information, you're getting world, national, and regional.
No, I think that's a really fair point that we have many businesses, including Washington companies, that have a broad national footprint, international footprint. That's a very valuable source of information. Why is it valuable to hear from business leaders about what's going on in their world? The data we have at the national level is always stale in some sense. So we're struggling right now to think about what's happened to real GDP growth in the second quarter. We've gotten a couple of readings on that. Well, the second quarter ended in June. We sort of want to know what's going to happen in June next year. And one way we have found that's useful in those lines is to be talking to business leaders about what they think is coming around the corner in their world.
So we heard that, but also the other perspective that I think is fascinating to talk about a little bit more is we heard about specific social issues right in downtown Minneapolis and St. Paul. And one of the things we talked about is that all of the information in the room filters right down to Main Street, and you're getting the Main Street perspective as well from the nonprofit perspective.
I think this is a really important thing. When we have a dual mandate, that means and the second mandate is promoting maximum employment. One way to get a vision of what maximum employment is to talk to employers, but it's also important to get a vision of it from the workers' perspective. It's important to get a perspective. I just talked about the forces weighing on household demand. It's important to get a perspective on how households are perceiving the world. And so I think our boards will provide that perspective, but we have a lot of activities in community development that also help us provide that kind of information about not just what our local business leaders seeing, but also community leaders, and helping us understand the world not just from the perspective of the employers, but also the employees and the consumers in society.
In addition to the research department as well.
I think the research department is an information gathering piece, but their real power is more also in the analysis. I think you can get all the information, but you have to have a way to put it together into something, and the research department is great at facilitating that for us.
Diane, David, do we have a question?
Thank you, Larry. We've had a lot of great questions that have come in by text and over Twitter from our live audience. The first question that I have is actually a two-part question, Narayana. Can the Fed control asset bubbles? And second, does the quantitative easing increase the likelihood of asset bubbles?
So this is a question you hear a lot about, and I think what is so let me talk about, first of all, it's not what does an asset bubble mean, and for me when I think about this, that there's a heightened risk of a rapid fall in asset prices. It's not so much about how high asset prices are. I always look forwards, and so the question is there a heightened risk of a rapid decline in asset prices? That by itself, to be frank, is not in my mandate. I describe what my goals as a monetary policymaker are. It's all about the impact such a decline would have on unemployment and inflation. I think that when interest rates are low, that's another way to say that is that bond prices are high. And if bond prices are high, many other asset prices are going to be high. The other thing that's true when interest rates are very low is that people are very sensitive to the long run. When interest rates are very high, people pay attention mainly to what's happening in the next year or two. Interest rates are very low, they're going to pay attention to information and news that they're getting about the far distant future as well. So putting all this together, I think that when in a world where interest rates are low, there is an increased, asset prices are going to tend to be high, so people are going to be talking about bubbles, as they often are. And there is a heightened risk of asset price sensitivity to news about the long run. So both of those statements are true about about a low interest rate policy. The question for the Fed is, how do you weigh that off? How do you weigh off the risks to inflation and unemployment that might be associated with these heightened volatility in asset prices against the benefits that we're getting from low interest rates stimulating the demand for consumption and investment that will lead to higher employment and prices. This is something that, I'll speak for myself here, that kind of weighing exercise is something I go through all the time when I think about monetary policy. It's a risk-reward kind of trade-off situation. At the current time, I don't see the risks from a rapid asset price decline to spilling over into inflation and unemployment as being sufficiently material to lead me to think that that's something that would influence my decision making about monetary policy. There's a follow-up question about quantitative easing. I think all of this, to me at least, quantitative easing and low interest rate policies are basically the same kind of thing. You're just trying to drive down interest rates in order to stimulate more spending by households and firms in order to generate more prices and higher employment. And I'll back up and say one last thing about this, which is that the Fed is not keeping interest rates low for the heck of it. We're doing it to achieve our objectives. And the question really is, what has changed in the world? If we had been keeping interest rates at 0 in 2005, you'd have very high inflation and very low unemployment compared to what we have now. What has changed in the world? And I think the driving force for Fed decision making is really a background where there's a lot more demand for safe assets and for assets that pay off over the longer run than there was in 2007, 2008. And this goes back to this fear issue that we're talking about. And people are afraid of what can come down the road, but they want some way to be sure they're going to have something that'll pay off in the future. So households are holding, want to buy long-term assets like bonds, and then firms want to keep money in that kind of in bonds as opposed to engaging in capital expenditure. This is true in the United States. It's true around the world. And then the quantity of what's considered safe. 2007, Greek debt was safe. It's not true anymore. So a lot of things that we thought of as being safe in 2007 and 2006 are no longer safe. So the demand for safety has gone up. The supply of safety has gone down. That means interest rates are going to be low. That means the interest rates the Fed has to maintain in order to achieve its goals have to be low. That does introduce these risks that we just talked through about to asset price, in terms of asset price volatility, and you have to weigh off those risks against the rewards of trying to achieve your objectives in prices and employment.
You answered this in the last question a little bit, but with a little more specificity. That all of us over the last couple of weeks have been watching the market go up and down, and so with the volatility in the market for the last couple of weeks, how does that impact your thinking on monetary policy?
The volatility we've seen in the last couple of weeks, I think, has not changed my perspectives on monetary policy. I think, I had given speeches going back to 2013 that we probably should expect some degree of sensitivity to news about the long run and information about the long run. In this case, I think the information is really about how much global demand for goods and services is going to be there, not next year even, but 5 to 10 years down the road. I think some of those uncertainties are associated with what are the growth prospects going to be in China. But really, it's a global question that's out there. So I had been talking about the possibility of this going back for really 2.5 years. So having this kind of burst of volatility, I think, were something we could expect. The question for us has to be, how does that influence the risks that we see to our outlook for inflation and unemployment down the road? And I didn't see anything in the recent volatility to make me concerned about that.
So you talked about demand. Talk a little bit about China then. How does China impact? And for that matter, why don't you go to Europe after you talk about China a little bit?
And how long do you have? No, these are big questions. I think what we are, I think what's I'll talk in terms of talking about China. China has grown very rapidly for going back to 30 years. Historically unprecedented run of very rapid growth. At times running at 10% per year. More recently, it's 7% per year. And I think there's an anticipation that at some point that's going to slow down. And the question is, when is that going to slow down? What form is that going to take? And I think those uncertainties, and as I said, these are sometimes short-term issues, but they're really longer-term issues about where China's per capita income remains, I'm going to say about, I don't want to be quoted on the exact number, but maybe about 1/7 of the U.S. So there's a lot of room for them to go in terms of catching up in terms of per capita income. Where will they settle down relative to us? How long will that take? These are all important questions for firms around in the United States that are thinking about how big will that Chinese market be. Firms in Europe, when they're thinking about their production, how big will that be, Chinese market be. So those uncertainties are I think, have been driving some of the volatility we're seeing in the markets. In terms of Europe, Europe is facing a very challenging situation where they have had very high unemployment and very low inflation for quite some time. So their target for inflation is similar to ours, 2%. They're engaging in asset purchase programs now to try to achieve those objectives. They have an additional layer of they're separate countries that are joined together in a monetary union as opposed to 12 districts. They have over 25 countries that are joined together in a monetary union. So they have to work together to find a common place along those lines. You see some signs of improvement. Unemployment has fallen below 11% in Europe, which is the Eurozone, which is a positive thing. But you know, I look at Europe and I look at our own situation. I just think, you know, you don't want to get yourself in that situation. By that situation, I mean one where you're using every tool you have to try to, and you're facing a situation where inflation is really low and you're trying to drive it back up to target. We're doing a little bit of that, but their situation is even more profound than ours.
We'll talk about inflation next, but then when we're done with that, we'll grab another question, Diane. So you've talked a lot about inflation expectations this evening. You wrote a Wall Street Journal op-ed recently about raising rates would be a mistake. There's a lot of, we could sit here the rest of the night and talk about inflation expectations, but I think one of the things that would be
Can't we?
But I think one of the things that would be interesting to dig into a little bit more is the labor component of that. The labor shortage not translating into wage increases, which therefore impact inflation. So if you could talk a little bit more about that, I think that would be useful.
Yeah, so let me talk a little bit about that, which is that right now, as I talked about, inflation is at 0.3%. So that's what's called headline inflation. That's including the prices of goods and services related to food and energy. Often we strip out food and energy, goods and services, and the reason we do that is not because we don't care about those goods and services. It's because they move, the prices of those goods and services related to food and energy move around a lot, and they're in a transitory way. So one of the reasons that headline inflation is at 0.3% right now is because gas prices have been moving downwards. They're not going to keep moving down at the same rate for the next 3 years. It's just not going to happen. So as I think about where inflation is going to go in the future, I want to take that out. So having said all that, when I take all that out, inflation is still low. It's at 1.2%, which is about as low as it's been in 4 years. Why does the committee think that inflation is going to return gradually back to 2%? I also think that inflation will return back over some time frame, I think several years, to 2%. And it's because these forces that you just mentioned in the labor market, that as employment becomes scarce enough, workers will bid up their wages when firms will be bidding up wages for workers. And given they have to pay a higher cost to hire workers, firms will then translate some of that onto customers and consumers. And that will lead to higher wage and price inflation. And that's what's going to lead inflation back to 2%. That's the theory. Now, the practice of it is that when this happens and what trigger point in terms of unemployment will set this off is very hard to know. It's especially hard right now because one thing we saw over the last 6 years is a decline in the number of people who are in the labor force. That means they're neither working nor officially looking for work. But one of the things, if you look in the data, is a lot of people who say they're not looking for work actually get jobs. And so one possibility is a number of these people who have left the labor force are actually going to be willing to come back in once they start to see more hiring going on. And they're going to continue to put downward pressure on wages, even as unemployment falls below historically normal levels. I think the theory theory is clear. When that's going to all kick in, I think is really more uncertain. I'm concerned that inflation is just a ship that's really hard to turn. It's not something that a core inflation when you strip out food and energy. It's not something that turns on a dime. It's going to take a long time for us to get back to our targeted objective of 2%. And I worry the longer we take, the more there's a threat that we can have a decline in what people expect inflation to be. This is what's happened in Japan, for example. You see a little bit of it happening in Europe. We see a little bit happening in our own, the kind of prices that people are willing to pay for inflation protection in bond markets have declined markedly over the past year or so. If inflation expectations decline, then this mechanism I just described is going to be more challenging because you're going to have to move up not just where inflation is itself, but where people expect it to be going in the long run. That's an even harder proposition. And the Japanese have been struggling with that for 15 years, and they're using really unprecedented both fiscal and monetary tools to try to solve this problem in the last couple of years.
You talked about China and Europe, but what about our neighbor Canada, who is now in recession? Do you foresee any spillover into the U.S. economy?
So, I actually grew up in Canada. It was mentioned I was born in Baltimore, Maryland, but when I was about 11 months old, my parents, without extensive consultation, I might add, whisked me off to Canada.
But you became a hockey fan because of
I became a hockey fan because of that. That's true. But yeah, I was a fan of the Winnipeg Jets. But that's a whole new world of pain that I won't talk about. And the saying we had in Canada is when the U.S. sneezes, Canada catches a cold. The reverse doesn't work that way because Canada is basically too small a country to have an enormous impact on the U.S. With that said, I think what's going on in Canada is informative from some parts of our district. Canada is more commodity intensive and resource intensive as a producer than the U.S. is, and so the challenges they're facing are related to that place they have in the world economy, and so that's related to what's going on, for example, in western North Dakota and in other parts of our district that are more resource intensive. But in terms of it's spilling over to the U.S. as a whole, no, I don't see that as being a major risk at this time.
So one of the questions we got is to talk, you talk about inflation, low rates, talk about how that impacts the individual saver. And so the person that has a bond that's getting a low interest rate, close to retirement, talk about what people can do, they're close to retirement and saving and those types of things that are involved in interest rates.
Yeah, this is a challenge. I mean, I think that monetary policy is, as I talked about earlier, we set monetary policy so as to achieve these objectives of keeping inflation close to 2% and to promote maximum employment. These are very aggregate kinds of objectives that affect all Americans. But monetary policy definitely has disparate effects on different people in the economy. If you're a saver who's in a particular circumstance where you're rolling over your investments, you have a bond that you've held for some time. Sometimes I talk to older citizens that have had bonds for 30 years and they're now coming due. Those are paying very high coupons, and now you're trying to replicate that flow. It's very hard in the current low interest rate environment. And so if you're in a position in your life where you're trying to save, having these low rates of return makes it more challenging. With that said, the aggregate effects helps all Americans. It's a question of there's going to be some people are going to be helped more than others by the policy. Again, I think I'll harken back to an answer I gave earlier, which is that the reason savers are being hurt is not because of the Federal Reserve. It's because of the situation the Federal Reserve is forced to respond to. We're forced to respond to a world in which everyone wants to save. If you're trying to do the same thing as everyone else, if there's a bottle of wine you like and suddenly everyone else wants to buy it, you're going to have to pay a high price for that. If you are a saver and everyone else in the world in the wake of 2008 says, I want to save, you're going to pay high prices for that activity and face low returns. And the Federal Reserve's policies are merely ways of transmitting that effect to the overall economy. We're faced with a situation where everyone wants to save. That makes us keep rates low in order to achieve our objectives, and that's transmitting that force through to Americans as a whole. I would love to be in a world where people felt more security, so we didn't have this force of demand for saving, and we can have higher interest rates in order to achieve our objectives. And I anticipate that world will come.
So we're in a college town. So one of the questions we got is, what do you feel are some of the important things that colleges and universities can do, to collaborate with both the private sector, government, the Federal Reserve for, the betterment of the regional economy and the national economy?
I think there's been a lot of research done on university education, college education. It's one of the investments that has one of the higher returns that you can think of. We were just talking about low returns. Human capital is a high return investment. Most studies find that on a risk return, it's an investment that has a higher return typically in the stock market. So these are investments that I think are pay off obviously for the person who's doing it, the student, but I think there's also social returns that pay off for the region. With the Federal Reserves, we cooperate in terms of data sharing. We talked about our research department. We have a very close connection with the University of Minnesota's economics department because of the proximity. That's been really helpful to us to have a better understanding, not just of our local economy, but the nation's economy. I think that the things I just talked through are probably relatively well known to lots of people. A point I want to emphasize, which doesn't get as much attention, I think, is the research role of universities and how important that is. You look at the real engines of creativity in the United States, places like Silicon Valley, in Austin, Texas, I would say Minneapolis. These are all places where you see a lively flow of ideas and innovation from the university into the business world and back again. I think facilitating that has history suggests that that's been very positive for local economies.
So let's talk a little bit about the Minneapolis Federal Reserve's new Indian Country program.
Yeah.
So talk a little bit about that, and also access to capital in those areas, and a little bit what the Federal Reserve is trying to accomplish with that.
So this is Larry's referring to the fact that a couple of weeks ago we launched a new initiative in the Federal Reserve Bank of Minneapolis called the Center for Indian Country Development. I say new initiative, that's very misleading. This is actually a way of institutionalizing, building on work that actually has been going on in our bank for at least 20 years. What the approach we've been taking in our bank has been to work with tribes to improve the application of collateral protection laws on the reservations. As you all know, reservations are sovereign in our country. They have the ability to have their own collateral laws respecting collateral in lending arrangements, and so that means that things like the Uniform Commercial Code don't automatically apply on Indian reservations. So one of the things that we've been working on in the Federal Reserve Bank of Minneapolis, among others, is in terms of facilitating an engagement between tribes and ways they can adopt useful aspects of the Uniform Commercial Code in order to have better protection for collateral. This is a way to help capital flow into Indian country. Now, it's not the only way, and I think one of the things we realized over the past 20 years is the challenges that are out there in Indian country are just huge and linked. And there's a lot of work going on economic development in Indian country it's coming at the problem from many different angles. Our hope is this center will be a way to it's really a way of facilitating conversations and bringing people together to make them each aware of the different aspects of the problem they're trying to tackle. So we have two co-directors for the center. One is a longtime employee of the Federal Reserve Bank of Minneapolis based in Helena, Sue Woodrow. She's been leading the effort on the Uniform Commercial Code that I talked about. And Patrice Kunesh, who just joined us, long experience of working in Indian country. I think they're both going to do a great job of broadening and deepening our connection with Indian country development. So I'm very excited about this. I think I think in 5 to 10 years we're going to see some real progress here.
So I'm going to ask you one more question, and we'll come back for a final Twitter question, and then we'll start to wrap it up. So tell us about Jackson Hole. We were talking about that before we came up here, the meeting last week with central bankers from all over the world. What were your takeaways from last week in Jackson Hole?
So the Federal Reserve Bank of Kansas City has a policy conference every year that you fly into Jackson Hole, but it's actually not in Jackson Hole. It's in the Grand Teton National Park in the National Park Lodge. It's a nice place, but we make a wrong turn when we come out of the airport at Jackson Hole. We don't go to Jackson Hole, we go the other way. But with that said, it's a great conference. It's a way for academics to present their ideas to policymakers and have us as policymakers learn about what's going on in the academic sphere to help us. This particular conference was about inflation and some of the challenges in understanding why inflation moves the way it does. And this is, of course, central, as we talked about. Our goal is to try to manage inflation. I thought it was informative to hear about a lot of the ideas, and I think our staffs in particular, as they think about how to forecast inflation, help us guide inflation back to where we want it to go. I think we'll find it informative. I thought that I worried that some of the media coverage suggested that central banks have no idea how inflation works, and that was far too extreme a takeaway. My own takeaway is that there's certainly gaps in our understanding. There always are, but there's a lot of strong evidence that our staffs are very good at forecasting inflation. So one way to see this is if you go, my very first meeting in November of 2009, October 2009 maybe, at the FOMC, our staff made a forecast for inflation for the next 5 years. And so unemployment's at 10%. Many people are thinking, okay, we're going to have deflation. So inflation is actually going to go negative. Our staff they forecast correctly that inflation was not going to fall below 1%. And 5 years later, their forecast for inflation was that it was going to be 1.6%, right? And now I'm talking about core, stripping out this volatile food and energy, which is very hard to forecast over a 5-year horizon. But core, they forecast would be 1.6%. Right now we're at 1.2. There's a gap, but they're pretty close. And they foresaw in 2009 that unemployment would be below historical levels at 4.7%, and that was their forecast. And but inflation would still be below target, and well below target with really years to go. I think what's been challenging so I actually think if you look at the record, our staff has done a great job of forecasting inflation. The challenge is that the rate of growth that went along with that, real growth, was much slower than they are, our policymakers and really private sector forecasters forecast. And that's been the story of the recovery, is not the challenge of forecasting inflation as much as the challenge in forecasting the level of real growth that went along with that inflation.
Diane?
Are negative interest rates only theoretical, or is there real policy behind negative rates?
Well, this is a great question. So I'll answer it in a couple of different ways. So economists like to distinguish between real and nominal interest rates. And so nominal interest rates are the rates you see that if you go to a bank, that's a nominal interest rate. By real, we net of inflation. We subtract out the loss of purchasing power when you hold say a bond over time. The dollars you're going to be getting in the future, how much the goods they can buy is shrinking over time because of the impact of inflation. We net that out. That's called the real interest rate. Real interest rates we always knew could be negative. nominal interest rates, the rates you see out there in the world, people talked about the zero lower bound on interest rates. And it was thought that interest rates could not go below zero. And the reason for that is people can always switch to cash. Cash is a way to hold an asset that pays a zero interest rate. So how could any bond pay a negative nominal interest rate when everyone could say, well, I don't want to hold that bond, I'll hold cash instead? Well, it turns out you can have negative nominal interest rates, and we've seen it in European countries, in Switzerland and in Denmark and in others. In fact, at times this year, I think there were Swiss bonds out to 5 years in their term structure that were paying negative nominal interest rates. So what does that mean? That means people are paying $100 a day to receive less than $100 in 5 years. Why aren't they holding cash instead? Well, you think about it, I guess maybe we should have for a few minutes, you realize if you've got a lot of money to invest, cash is a little bulky, a little hard to store. It's hard to make that substitution. So I think the thinking now is that negative nominal interest rates are possible. They're still viewed that you can't make them arbitrarily negative because people, even if you have a lot of resources to invest, eventually you will switch to cash. I think that central banks in Europe have found that for their purposes, their objectives, that it is useful to go to a negative nominal interest rate in order to stimulate even more spending. That people think that they're getting a negative nominal interest rate by holding financial assets, that makes them even more willing to spend today, pushes even more up in prices and employment in these countries. And they're all, I think in both situations, they were facing downward pressures on inflation, largely from their exchange rates. So, but yeah, this has been a very humbling, among many dimensions for economists, a very humbling time period over the last 7 or 8 years, because many things we thought were true have proven to be things are not true. And this idea that you can have persistent, protracted negative nominal interest rates is one example of that.
So a personal question. You decided not to renew your decision not to renew your term at the Federal Reserve Bank of Minneapolis. Tell us a little bit about your thoughts on heading to Rochester.
Yeah, this was an amazing opportunity to have this job. I was very happy as a university professor, but the opportunity to take on this responsibility at a time of severe economic crisis in our nation. So I became president in October 2009. It coincided, and it's purely coincidence, the unemployment rate peaked that month at 10%. And so it was really an extreme, I think an economic emergency in our country, and being able to serve in this role over that time frame, it's just been a real honor and privilege. And the people I get to work with, my bank, and nationally in the Federal Reserve System are really inspiring in terms of just the dedication to the national interest is really remarkable. So that's what motivated me to take the job, and what I found great about having the job. But so many ideas. I just talked about the humbling experience of economists, and I think that the next step that I'm hoping to be able to contribute to the thinking that will help prevent the next crisis, or if there is another crisis, make us better at responding to it. The best, that's a goal. It's aspirational. Who knows what I'll be able to do? But that's something you could do in academia, and so that's what I'm thinking. Going back to academics is try to work on those kinds of problems. But as I said, it was an enormous honor to have this job, and I'm sure I'll always remember it as being one of the great highlights of my life. So.
Well, we've run out of time, and I can't tell you how fortunate we are to have you here in Missoula, Narayana. I mean, a person in the responsibility that you've got and the stature you have, to be willing to sit with us and part of our community and be free-flowing and have a conversation like this is really remarkable and something that we don't experience all the time. So we give Narayana a big hand. That would be great.